You know, there is this very strange, almost cruel paradox built right into the fabric of the financial markets.
Yeah, it really is.
And it's one that we rarely stop to actually question. I mean, think about almost any other profession in the world, right? Any other high-level discipline.
The equation for success is usually pretty straightforward.
Exactly. It's linear. Effort equals output. Like the lawyer who spends the most hours grinding through case law, they get the strongest defense.
Right. Or the athlete.
Yeah, the athlete who spends the most hours in the gym, builds the most muscle. The software engineer who writes the most code builds the most robust application. It's a predictable, deeply comforting reality.
Because we are raised to believe that doing more yields more.
Right. But then you step into the world of trading. You sit down in front of a glowing screen in a quiet room. The charts are just pulsing right in front of you, and that linear equation completely shatters.
Completely falls apart.
Because in this environment, the operator who trades the most, the one who exerts the most physical and emotional effort, they are almost never the one who profit.
No, they're the one who burns out. It's the ultimate inversion of our natural programming. And the market is entirely unapologetic about it.
Utterly ruthless.
Because we are biologically, and I'd say culturally, wired to equate activity with progress. If we are moving, if we're clicking, if we're analyzing, we feel like we are working.
Like we're doing our jobs.
Exactly.
Yeah.
But the market actively, sometimes violently, punishes that exact instinct.
And looking at the stack of research and playbooks we've gathered for this deep dive today, I mean, that punishing reality is the entire focal point.
Yeah, it's the core of everything we're looking at.
We're pulling from this highly specialized, tightly guarded set of institutional trading frameworks. Specifically, we're looking at the core doctrines from the Session Trading Lab, dealing range methodologies, and mechanical system design.
Really heavy mechanical stuff.
Right. And as I was reading through this material, trying to synthesize what actually makes the professional operator survive while the retail trader just gets destroyed, one phrase kept anchoring the entire philosophy. A phrase the STL doctrine calls discipline over dopamine.
Discipline over dopamine. I love that.
It's just profound. Because today's deep dive, for everyone listening, this isn't about finding a holy grail indicator. This is about taking a scalpel to our own psychology.
And that's usually the part people want to ignore.
Oh, totally. We're exploring why the vast majority of traders fail, not because they misunderstand where the market is going, but simply because they lack the emotional patience to wait for the right time to enter.
Which means mastering what is arguably the hardest skill in the entire financial landscape.
Doing absolutely nothing.
Doing nothing. Sitting on your hands until conditions are perfectly structurally aligned. It is all about surviving the noise.
Because the noise is designed to be seductive. Okay, let's unpack this because we really need to talk about that seduction.
The participation trap.
Yes, the exact opposite of discipline. Reading through these institutional contrasts between the retail mindset and the professional mindset, the divide is staggering.
It's like two different species operating in the same environment.
I mean, the retail trader is entirely focused on profits, hope, and constant activity. But the professional operator's hierarchy doesn't even prioritize profit first.
No, profit is at the bottom of the list.
Right. It prioritizes survival, then risk control, then process, and profit is just, well, it's the eventual byproduct.
What's deeply fascinating here, and I think we really need to sit with this, is the neurochemical driver behind that retail behavior.
The biology of it.
Exactly. We have to ask, why do emotional traders constantly feel this burning, undeniable pressure to just get in the market, to always have an open position?
Like an itch they have to scratch.
It actually comes down to how our brains have evolved to interpret moving data. You sit there, the market is constantly ticking. Up, down, flashing green, flashing red.
It's hypnotizing.
It is. And the human brain registers that continuous movement as potential. And when the brain perceives potential, what does it do? It releases dopamine.
Which most people think of as the reward chemical, right? Like, I ate something sweet, I feel good, that's dopamine.
That is the common misconception. Dopamine is not the chemical of reward. It is the chemical of anticipation.
Wait, really?
Yes, it is the chemical of motivation and craving. It demands action. Evolutionarily, it's what drove us to hunt when we saw a rustle in the bushes.
Wow, okay, that makes so much sense.
So the trader is sitting there staring at a flickering green candle on a 1-minute chart. The dopamine spikes, and the brain literally screams at the nervous system, there is opportunity here. Act now, or you will starve. Act now, or miss out.
And that leads directly to the impulsive entries.
Exactly. It creates the fear of missing out, chasing price action, and compulsive execution long before any actual structural confirmation exists.
It's a profound neurochemical problem.
That the trader is desperately trying to disguise as a strategy problem.
I want to sit with that for a second. A neurochemical problem disguised as a strategy problem. Because, it genuinely feels like an intellectual pursuit when you're doing
You
it.
feel very smart drawing your lines.
Right. You're drawing lines, you're looking at indicators, you're calculating moving averages, but really you're just rationalizing your body's demand for a chemical hit.
You're finding a logical excuse to click the button.
It makes me think of being in a massive, high-end casino. It's like an amateur player sitting at the blackjack table, feeling this overwhelming, almost physical urge to bet heavily on every single hand just because cards are being dealt.
Because the game is happening in front of them.
Exactly. They feel that if they aren't pushing chips into the middle of the felt, they aren't actually playing the game. Meanwhile, the institution just sits back.
The house never sweats.
They don't sweat, they don't force it, they just wait for the mathematical edge to play out over thousands of hands. But I have to push back on this a little bit on behalf of the person listening right now.
Go for it.
If I am sitting at my desk, my screens are glaring, I've cleared my entire morning to trade, and I'm just watching price move for 3 hours without clicking a single button, isn't the whole point of trading to trade?
That's the logical assumption, sure.
Right, because if I'm just sitting there doing nothing, it genuinely feels like I am failing. It feels like I'm wasting my time.
That feeling, that exact friction you just described, is precisely what the market preys upon.
It feeds on that boredom.
Absolutely.
Okay.
If we connect this to the broader institutional framework, we have to completely redefine what the word effort means in this context.
Okay, how so?
As we discussed, in most professions, effort applied generates output. But in trading, effort applied outside of your specific, mathematically defined edge window produces a negative output.
It literally takes money from you.
It destroys your capital. The harder you work at trying to find trades in a market environment that isn't actually offering any, the faster you will blow your account.
You are manufacturing your own destruction just to cure your boredom.
Yes. And the STL doctrine puts it perfectly. They say selective participation protects mental capital.
Selective participation.
We have to realize that doing nothing in front of a live moving market is not a passive state. It is an intensely active, high-skill activity.
It takes so much energy to not click the mouse.
An immense cognitive load.
Yeah.
Yet you sit there, watch your brain demand dopamine, physically feel the urge to click, and consciously, repeatedly choose discipline over that chemical hit. Professional execution looks boring.
Boring.
Boring?
Yeah.
If your trading feels exciting, if your heart rate is elevated, you're likely doing it wrong.
Wow. Selective participation. It's such a clinical, precise way to phrase it, because if constant impulsive participation, just throwing money at every twitch of the chart is the disease wiping out accounts, then understanding exactly when to participate has to be the cure.
That is the only cure.
And that segues perfectly into the mechanics of time. This was the part of the source material that really stopped me in my tracks.
Because this is where we transition from purely psychological defense to actual mechanical architecture.
Right, because the retail trader looks at the market as a random walk, right? Like a chaotic sea of price fluctuations that can just do anything at any moment.
But the market does not move randomly.
No. The playbooks are remarkably explicit about this. The market operates on highly scheduled, predetermined liquidity windows. And the mantra that is repeated page after page in this material is timing before direction.
Timing before direction, it completely upends the traditional approach to the markets.
How do you mean?
Well, think about it. Most retail traders wake up, they look at the news, they look at the daily chart, and they ask themselves, is the market going up or down today?
Right, they want a prediction.
They are obsessed with prediction. The professional operator wakes up and asks an entirely different question. They ask, what exact time will the market make its move, regardless of the direction?
And this introduces a concept the material calls the power of 60.
A brilliant framework.
It's the literal anatomy of an hourly candle cycle. And we're looking specifically at highly volatile dealing windows here, like the London Open, focusing around 1:12 a.m. to 2:12 a.m. Eastern, or the early New York session, around 8:12 a.m. to 9:12 a.m. Eastern.
The heavy volume hours.
Exactly. According to this framework, an hourly candle isn't just 60 minutes of continuous random pricing. It has a distinct three-part life cycle, a beginning, a middle, and an end, each with a very specific algorithmic
It
purpose.
is a programmed sequence.
Yeah.
And if we break down those phases, we can see exactly how the trap is set for the emotional trader.
Okay, walk us through it. What happens at the top of the hour?
The first phase spans from the opening of the hour minute 0 to minute 12. This is defined as the accumulation phase.
Minute 0 to 12, accumulation.
Right. During these 12 minutes, the direction of the market is intentionally muddy. It's unclear. Orders are quietly building up on both the buy side and the sell side.
And the doctor is incredibly strict here. The rule for the 0 to 12-minute window is no entry, no exceptions.
None. Because this is the exact zone where the retail trader, desperate for that dopamine hit we talked about, gets chopped to pieces.
They see a sudden burst of momentum at, like, minute 4, and they assume the hourly trend is starting, so they dive in.
And they are diving headfirst into an algorithmic trap, because that early participation leads directly into the second phase, from minute 12 to minute 20.
The danger zone.
Yes, this is the manipulation phase. In institutional circles, this specific 8-minute window is often referred to as the Judas swing.
The Judas swing. It betrays you.
Exactly. It is designed to betray your early conviction.
Let's look at the tape during this phase. During these 8 minutes, the algorithm deliberately hunts liquidity.
It's looking for victims.
It will abruptly, and often violently, sweep above recent structural highs or dive below recent structural lows. And to the untrained emotional eye, this looks exactly like a legitimate aggressive breakout. It triggers massive retail FOMO. People see price rocketing upward at minute 15. The green candles are huge, and they buy in, totally terrified that they are going to miss the big move of the day.
But the rule for the professional operator during the 12 to 20-minute window is absolute. Watch only. Do not participate.
It's like watching a master illusionist on stage, you know?
How so?
Well, for the first 20 minutes of the act, they are waving their right hand around wildly, creating flash, sound, and distraction. That's the manipulation phase. They're trying to get you to look the wrong way, to commit your attention, or in the trader's case, to commit your actual capital to the illusion.
That's a great way to picture it.
But the real trick, the actual sleight of hand, is happening quietly out of sight with the other hand. And it doesn't reveal itself until after minute 20.
That is a beautiful analogy. The manipulation is purely a theatrical device to generate fuel. Because after the illusion comes the reality.
Phase 3.
Minute 20 to minute 45. This is defined as the distribution phase. This is the highest probability participation environment in the entire 60-minute cycle.
The real move.
Yes. Once the manipulation has occurred, once the liquidity has been aggressively swept and the early emotional participants are trapped in bad positions, the true expansion of price finally happens.
And this is exactly where the emotional trader is completely out of sync with the underlying rhythm of the market.
They're on the wrong beat entirely.
Driven by dopamine, they are constantly entering during that 0 to 12-minute accumulation, getting chopped up, or they're getting baited into the 12 to 20-minute manipulation swing. They just want the rush of being the first one of the party.
And being first in the financial markets usually just means being the liquidity for someone else's much larger order.
Brutal.
But true. Professional operators remain emotionally grounded enough to simply sit on their hands for 20 minutes, calmly watching the trap spring on everyone else.
They let the illusion play out.
They wait for that 20 to 45-minute window because they understand a foundational truth. Patience creates precision.
Patience creates precision. I want to pause on that. You are literally waiting for the market to exhaust its deceptive maneuvers, allowing it to show its hand before you even consider risking a single dollar.
Exact.
But this brings up a really crucial mechanical question for me. We know the clock is ticking. We know that between minute 12 and 20, the market is manipulating. But what exactly is the market hunting during that Judas swing? We keep using the word liquidity.
Right, it's a buzzword.
Yeah, but for the listener trying to visualize this on a chart right now, what is it actually reaching for?
To understand that, we have to look at the market not as a chaotic battlefield, but as a highly efficient, centralized matching engine.
A matching engine.
Its singular purpose is to pair orders. For every buyer, there must be a seller. It uses price to travel across the chart to access counterparties. Liquidity is simply the lifeblood of that mechanism.
And according to the playbooks, those counterparties aren't just hiding randomly on the chart. They are clustered.
Very predictably clustered.
Sell-side liquidity rests just below structural lows on the chart. Buy-side liquidity rests just above structural highs.
Which brings us to a psychological hurdle that almost every retail trader struggles to overcome. Imagine this scenario. An emotional trader enters a long position a bit too early.
Okay, they're in.
They do the responsible thing, right?
Yeah.
They place their protective stop loss just below a recent obvious low on the chart. Then, they sit back and watch the market come down, specifically trigger their stop loss, take them out of the trade for a loss, and then immediately reverse and rocket upward in their original intended direction.
Oh, that's the worst feeling in the world. When that happens, it feels deeply, violently personal. It feels like the market is a sentient entity that looked at your specific account balance and decided to destroy you.
Oh, absolutely.
You see people screaming online, the algorithm knows where my stop is, the broker is hunting me.
Yes. But the cold hard truth is that it isn't personal at all. It is just the mechanics of order pairing.
How does that work at the institutional level?
Well, think about large institutions, central banks, massive hedge funds. They are operating with hundreds of millions, sometimes billions of dollars. They cannot simply hit buy at market like a retail trader can.
Because their orders are too big.
Way too big.
Yeah.
If they try to execute a massive order at current market prices, there won't be enough sellers, and they will drive the price up against themselves, causing massive slippage.
Right, they'd ruin their own entry price.
Exactly. If they want to buy a massive block of an asset, they need an equally massive block of sell orders waiting in the dark to pair their buys against.
And where is the biggest, most convenient, most predictable cluster of sell orders? It's sitting right below the most obvious recent low on the chart. It's the pooled stop losses of thousands of retail traders who all bought early and put their safety net in the exact same spot.
Precisely. The institution needs to acquire assets cheaply. So during that manipulation window, they briefly drive the price down into that pool of stop losses.
Sweep.
The sweep. The retail traders are mathematically forced to sell their positions at a loss. The institution buys those discounted assets, completely filling their massive order, and then the true distribution phase begins, driving the price up.
So the emotional trader wasn't targeted. They were just the necessary raw material. They unwittingly provided the liquidity for the institution to do business.
It's just the cost of liquidity.
The sources highlight specific structural footprints of this happening on the tape, too. They talk extensively about failure swings.
Ah, yes.
Let's break that down. A failure swing is when price moves down toward a previous low, but intentionally fails to actually break below it.
It stops just short.
Right. It creates a temporary bottom, bounces up a bit, and then comes back down, again failing to break the low. To a retail trader reading textbook technical analysis, that looks like incredibly strong support. They think, look, it held twice, it's a double bottom, I'm buying.
That's what the books tell them to do.
But to an institutional operator looking at the exact same chart, that is the deliberate construction of a liquidity pool. It's a buildup of low-resistance liquidity. The pool of stop losses resting just beneath those safe lows is getting deeper and deeper and deeper.
A massive pool of fuel.
And eventually, the algorithm is going to slice right through that manufactured floor to collect all those orders.
We see this principle mechanically aligned with specific times of day as well. The sources point heavily to the 9:30 a.m. Eastern Standard Time opening bell in New York.
The NY Open, always wild.
Very wild. But to the professional, the 9:30 a.m. open is rarely the true start of a trend. It is very frequently a massive manipulation event, a macro Judas swing designed to aggressively clear out all the liquidity that built up above and below the market during the quiet Asian and London overnight ranges.
It just wipes the board.
It is the algorithm sweeping the board clean, pairing massive institutional orders before the real daily distribution path is allowed to begin.
Okay, here's where it gets really interesting, because the theory has to meet reality. If I'm listening to this and I'm staring at my charts tomorrow, and I now understand that the 12 to 20-minute window is manipulation, and I understand that the sudden drop below a low is likely just a sweep for my stop loss, I mean, how do I actually survive it?
That is the million-dollar question.
Because how do I know if a sudden, violent downward move is just a manipulation sweep designed to trap me, or if the market is actually just crashing and the trend is genuinely changing? How do I stop being the fuel for someone else's order?
That is the most important question a trader can ask.
Yeah.
Because the answer is not about having better intuition.
It's not a gut feeling.
Never. You do not survive by trying to guess the absolute bottom of the sweep. Trying to catch a falling knife is ego-driven trading.
So what do you do?
To avoid being fuel, you must suppress your emotional urgency, wait for the sweep to entirely conclude, and then look for a very specific mechanical footprint, the source called displacement and structural confirmation.
Which brings us to the core mechanical framework of the institutional operator, the absolute transition from emotional guessing to mechanical execution. The sources lay out a strict, non-negotiable checklist called the pre-entry gate.
It's a pre-entry gate.
And looking at this, it is beautifully unforgiving.
It is the architecture of discipline. An emotional trader operates on intuition, adrenaline, and a feeling of, I think it's going up. A professional operator uses a strict filter.
A gate.
Yes, a literal gate. If the environment does not pass the filter, capital is not deployed. Let's break down the mechanics of this pre-entry gate because it leaves absolutely no room for interpretation.
I'm looking at the criteria here, and it seems impossibly strict. Walk me through the first hurdle of this gate timing. If the setup looks absolutely perfect, but it's minute 14 of the hour, what happens?
Nothing happens. The gate remains closed.
Nothing.
Nothing. The first criterion is timing. Are we currently inside the 20 to 45-minute distribution window? If it is minute 14, you are inside the manipulation window, you are in the Judas swing.
Even if the pattern is flawless.
It does not matter how good the pattern looks. It does not matter if every indicator is flashing green. If the timing does not align, the probability of it being a trap is simply too high. You stand down.
Okay, so let's say we wait. It's minute 22. We've passed the timing gate. What is the second lock on this door?
The second criterion is order pairing. Has a sweep of a dealing range side been structurally confirmed? We do not anticipate a sweep.
So no guessing.
No guessing. We do not look at a low and say, I think the market will sweep that low, so I'll buy right above it.
Yeah.
You wait to see the low actually violently taken out. You must have visual proof that liquidity has been accessed by the algorithm.
All right, the low is swept. Liquidity is taken. We're in the right time window. Do I buy now?
Absolutely not. That is where retail traders die, trying to catch the exact bottom of the sweep. The third criterion is displacement.
Displacement.
We need irrefutable proof that the institutions, having swept the liquidity, are now aggressively shifting the delivery of price in the opposite direction. We look for a clean, three-candle delivery shift or the creation of a fair value gap.
Let's pause and unpack both of those because they are critical. Explain the mechanics of a fair value gap, or FVG, first. What is it actually representing in the order book? Because people throw that term around like it's magic.
It's not magic, it's physics. A fair value gap represents a literal vacuum of liquidity.
A vacuum.
Imagine the market sweeps a low, pairs those buy orders, and then massive institutional buying pressure comes in. The market rockets upwards so fast, so aggressively, that the pricing algorithm physically skips levels.
It moves too fast to pair everything.
Exactly. There are 0 opposing sell orders paired in that specific price range. It leaves a gap in the tape, a space where only one side of the market was offered. That gap is an inefficiency.
And the market has to fix that.
The market, being an efficient matching engine, will eventually want to draw back down into that gap to offer fair value to the other side. Seeing an FEG created immediately after a liquidity sweep is a massive footprint of institutional sponsorship. It proves big money has stepped in.
And what about the three-candle delivery shift? The sources are incredibly precise about this. They don't just say, wait for a green candle. They specify a three-candle sequence.
Yes, because a single candle can be anomalous. Let's say the market is moving down, hunting sell-side liquidity. We identify the specific, aggressive down-close candle that actually swept the low.
The sweep candle.
Right. To confirm that the market actually wants to reverse and go higher, we wait. We wait for the market to print subsequent candles that close entirely above both the physical body and the highest wick of that initial down-close candle.
So it has to completely engulf the range of that sweep candle.
Exactly. And that almost always requires a minimum of 3 candles to unfold organically. It is undeniable, structural proof that the momentum is shifted. Is the market explicitly showing you its hand?
Okay, so we have timing, we have the sweep, we have the displacement. The fourth criterion is confluences. Having 3 or more structural reasons to take the trade. Is price reacting at a massive higher time frame level? Is it targeting a clear draw on liquidity above us? It's basically saying, if you only have one reason to trade, don't.
Correct. But it is the 5th and final criterion that is the ultimate filter. And it is entirely internal.
This is the hard part.
Emotional neutrality. The checklist demands that the trader assess themselves. Am I at a 7 out of 10 or above on a scale of emotional neutrality? Am I calm, breathing slowly, and completely detached from the monetary outcome?
And if the answer is no, if the setup is an absolute masterpiece, I mean, the time is perfect, the sweep was violent, the FVG is huge, the confluences are stacked, but I'm sitting there feeling a 5 out of 10 because I'm furious about a trade I messed up yesterday, or I'm hyper anxious because I need to make a car payment. What then?
Then the structure of the chart becomes entirely irrelevant. The gate remains locked. You do not participate. Because participation without alignment destroys your edge. If you front-run the confirmation,
Yeah.
if you enter before the three-candle shift prints simply because your dopamine is spiking and you are terrified the market will leave without you, you are no longer operating a mechanical edge. You are gambling.
Just rolling the dice.
You are gambling with a very sophisticated institutional vocabulary, but you are still just at the casino.
Gambling with a sophisticated vocabulary, that hits hard because it's so easy to trick yourself. You can draw all the elegant fair value gaps and dealing ranges on your screen, but if your heart rate is 120 beats per minute and you're clicking buy out of fear, you're not an operator. You're a punter.
Exactly.
But let's be real here. Having a pristine 5-step checklist is really easy when the market is closed on a Sunday afternoon and you're drinking coffee.
Oh, everyone's a genius on Sunday.
Right. But following that checklist on a Tuesday morning, when the candles are violently pulsing, the numbers on your screen are flashing red and green, and your dopamine is absolutely surging, that requires an almost inhuman level of psychological stability.
Which is exactly why the source material heavily emphasizes the concept of emotional containment.
Yeah,
It is not enough to simply have a list of rules written on a sticky note.
because you'll just ignore them.
The human brain, under chemical duress, will always find a way to rationalize breaking rules. You must have mechanical defense systems in place to physically enforce those rules when your biology is actively fighting against you.
And this leads to one of the deepest psychological explorations in the notes, the concept of contamination. When I read this, it felt like the authors had been looking over my shoulder during my worst trading days.
Contamination is a very precise clinical term for what happens to a trader's cognitive state after an emotional event in the market.
Okay, let's look at the scenarios they give.
There are two common ones. Scenario 1, you take a perfectly valid setup, everything aligns, but the market simply doesn't deliver, and you take a small, managed stop loss.
Frustrating, but normal.
Right. Scenario 2, which is often much worse, you witness a perfect setup forming, but you hesitate out of fear. You don't pull the trigger, and then you are forced to sit there and watch the market run hundreds of points in your intended direction without you.
Agony.
Both of those scenarios create a profound psychological injury.
Let's focus on that feeling, because it is intensely physical. When you miss a huge trade or you get stopped out by one tick right before the big move, you feel it in your chest. The jaw clenches. Your vision literally narrows on the screen. It's a fight or flight response, but there's nothing to fight except the glowing pixels.
That physical sensation is the contamination taking hold. The dopamine crashes, cortisol spikes, and it creates an immediate, burning, almost primal urge to revenge trade.
You just want to fix it immediately.
It forces you to subconsciously lower your standards for the next entry. The strict 5-step pre-entry gate you had 10 minutes ago suddenly feels too restrictive.
You start making excuses.
You become desperate to either make the money back immediately or to prove to yourself that you are a capable trader who can conquer the market. You are no longer trading the chart, you are trading your own damaged ego.
And the mechanical defense against this contamination is brutal, but clearly necessary. The doctrine calls it the 20-minute mandatory cooling period.
A literal circuit breaker.
If you take a loss or if you endure one of those severe psychological near-miss disruptions, you do not immediately dive back into the time frames looking for the next setup. You physically step away for a minimum of 20 minutes. No charts, no analysis, no entry. You have to let the cortisol clear your bloodstream.
The sources outlined a very specific, highly dangerous scenario regarding this. If a trader is stopped out during the 12 to 20-minute manipulation window, the Judas swing we discussed earlier, that represents the absolute highest risk for a dopamine and revenge spike.
Why specifically in that window?
Think about the cognitive dissonance. The trader knew the rules. They knew they shouldn't have been participating in minute 14,
Yeah.
but they broke the timing rule out of FOMO.
So they're mad at themselves.
Very mad. They got chopped up in the manipulation sweep. So now the pain of the financial loss is massively compounded by the guilt of their own lack of discipline. The brain cannot handle that cognitive pain, so it immediately seeks the dopamine hit of a recovery trade to soothe it.
They want a quick fix.
They want to flip their position, double their leverage, and force the market to give the money back right now before the true distribution phase even begins.
Okay, I have to challenge this 20-minute rule. I really do. Because I'm putting myself in the shoes of an active day trader right now. Let's say I'm trading the highly volatile New York Open. A 20-minute pause feels like an absolute eternity.
It feels like a lifetime.
The market moves so fast. If I am forced to physically walk away from my monitors, go make a coffee, and stare at a wall for 20 minutes because I took a small paper cut loss, I am terrified that I will come back and find that I have missed the absolute best A-plus life-changing setup of the entire week.
The FOMO is real.
If I have a funded account with a prop firm and I have a time limit to make my quota, I can't afford to just walk away. Isn't that risk of missing out counterproductive?
It is the most common visceral fear every active trader faces. But the institutional doctrine answers that fear with a very simple, profoundly grounding truth.
What is it?
They say, you cannot miss what was never yours.
Wow, that is heavy. Let's really break that down. You cannot miss what was never yours.
Let's run the math on your scenario. You take a loss,
Yeah.
you're emotionally contaminated, your cortisol is high, your patience is zero. Even if you stay at the screens and the absolute perfect textbook setup forms 5 minutes later, your execution will be flawed.
Because my mindset is broken.
Because you are trading from a place of fear and recovery, not neutrality. You will likely mismanage the perfect trade. You will exit entirely too early because you are terrified of it turning into another loss. Or you will move your stop loss to break even prematurely and get chopped out.
So even if the market hands me a gift, my contaminated mind will destroy it.
Exactly. The market will always be there tomorrow. The setups are algorithmic. They will repeat infinitely. But your financial capital, and more importantly, your mental capital, will not be there tomorrow if you allow emotional, revenge-driven trading to destroy them today.
It's about preservation.
A loss is just data. It is information telling you that your timing was misaligned. It is the cost of doing business in a probabilistic environment. It is not a debt that you must frantically recover before the closing bell.
The market always offers trades. Your edge is not. That quote is pulled directly from the STL framework, and it perfectly synthesizes what you're saying.
Your edge is finite.
Your edge is a fragile, finite thing. It only exists mathematically under very specific, calm conditions. The second you are operating from a place of revenge or desperation, your edge evaporates. You're just flipping coins.
Which is why this rigid discipline extends far beyond just knowing when to enter a trade or when to take a mandatory 20-minute pause. It extends to the ultimate act of discipline, knowing exactly when to pack it up, turn off the monitors, and walk away from the market for the day, even when the market's still moving.
And this brings us to the final piece of the architecture, session completion. Because according to these institutional playbooks, professional operators know exactly when their trading day is done before the opening bell even rings.
They map it out entirely.
They do not sit there and negotiate with the market in real time.
Because negotiation is always born of emotion. Just one more trade. Just let me round up my account balance to the nearest 100.
Oh, the rounding up. That's a killer.
That is dopamine talking. Professionals operate on predefined parameters. The session completion framework dictates that a trader must walk away under very specific conditions completely, regardless of how much time or volatility is left in the trading day.
Let's lay out those conditions. Condition 1. Your primary thesis has played out. If you sat down at 8 a.m. with a specific plan to capture a 50-point expansion during the New York Open, and by 9:45 a.m. the market delivers that 50-point expansion, you're done.
You take the profit and close the laptop. Condition 2. Your institutional target is reached. If you are holding a runner position, targeting a massive 4-hour fair value gap sitting above the market, and price violently taps that algorithmic level, the structural delivery is complete. There is nothing left to extract. You close the platform.
Condition 3 is the psychological safety net. Your emotional state drops below that 7 out of 10 threshold. If the chop of the market is wearing you down, if you've been sitting there for 3 hours and you feel your patience fraying, your jaw tightening, you don't push through it like you would at a normal desk job. You survive by walking away.
And condition 4 is the hard mechanical stop. The clock hits the 12 p.m. Eastern Standard Time, hard close. The sources are incredibly strict about this boundary.
Why noon?
By midday New York time, the high probability dealing windows have expired. Algorithmic volume drops. The environment shifts from scheduled delivery to unpredictable, low probability chop.
So, synthesizing all of this, what we are really talking about is a complete redefinition of a word that every trader obsesses over: consistency.
People misunderstand consistency so badly.
If you go on social media, most retail traders define consistency as making a profit every single day. If they have a red day, they feel inconsistent. They feel like utter failures.
But the institutional definition of consistency has almost nothing to do with daily profit. Consistency is defined as behavioral repeatability under uncertainty.
Behavioral
It
repeatability.
means executing the exact same calm, boring mechanical process, whether your account is up $5,000 for the day or down $500 for the day.
Following the script.
It means honoring the timing rules, waiting for the 20-minute distribution window, waiting for structural displacement, honoring the 20-minute cooling period after a loss, and walking away when the session is complete, day after day, week after week.
Because the math plays out over time.
The financial outcome of any single individual trade is essentially random, but the flawless repetition of the behavior over a large sample size is what mathematically extracts the edge.
And that ties perfectly back to that fundamental hierarchy we discussed at the very beginning of this deep dive, the overarching framework of the true operator. Survival first, then risk control, then process, then profit.
Profit is just the exhaust.
It's literally the very last output of the system. If you stay at your screens at 11:30 a.m. after your primary thesis has already completed and you've made your money simply because you are bored or because you are seeking the thrill of another entry, you are willingly stepping out of your edge.
You are risking your long-term survival for short-term entertainment. And the financial markets are a devastatingly expensive place to seek entertainment.
As we start to pull all of this together, I want to recap the core realizations from this mountain of source material, because the shift in perspective we've covered today is profound.
It's a paradigm shift.
The instinct to constantly participate, to always have a position open, to constantly feel like you are in the game, is the single most expensive habit in trading. It is not a flaw in your strategy, it is a neurochemical trap.
True edge is never going to be found in a magical combination of indicators or some secret candlestick pattern you buy in a course online.
It's an internal mechanism.
True edge is found entirely in the filtering mechanism of your own mind. It is found in the brutal discipline to sit on your hands and wait for the 20 to 45-minute distribution window. It is found in the patience to calmly watch liquidity be swept and wait for structural displacement to irrefutably confirm the move. Process over emotion.
The ultimate realization that separates the consistent, quiet minority of professionals from the failing, exhausted majority is this. The market rewards timing far more than it rewards emotional prediction.
Much more.
You do not have to be a macroeconomic genius. You don't have to be right about the long-term direction of the global economy. You just have to be precise about exactly when you choose to expose your capital to the noise.
Patience creates precision. Only timing survives the noise.
So I want to leave you, the listener, with a final quiet thought, something to deeply consider before you open your laptop and load up your charts tomorrow morning. We started this conversation talking about the muddy waters of the market, how it uses ambiguity to trigger your dopamine to make you feel like you have to act immediately, aggressively, just to survive.
The illusion of urgency.
But the next time you sit down at your desk and the candles start pulsing and you feel that immediate burning chemical heat in your chest urging you to just click a button and enter a trade stop, take your hand completely off the mouse, breathe, and ask yourself a